Thank you all for being here. It's great to see everybody. Special thank you to our fellow sponsors, InvestCloud, MSCI, Evergreen Link, and of course to Mark and his team for putting on a fantastic conference and bringing us all together. Really excited to be here. My name's Ben. I'm one of the co-founders and the CEO of Monarch Markets. And I'm going to talk to you today about Evergreen funds and Omnibus, which is a core focus for our business. To start, what is Monarch? We are a group of 22 people and 2 dogs occasionally in the office, based here in New York City, proudly backed by F Prime, Commerce Ventures, and working with some great fintechs, Apex Fintech Solutions, Altruist, Webull, and many others. Our core thesis is that both public and private markets neither really need a new platform to get access to investments. What's needed, especially on the public market platform side, is the core infrastructure, API infrastructure, to bring private markets into what we call public market distribution, really combining and converging private markets with private wealth. And so we're the piping, that API layer that sits between these 2 markets that are quickly coming together. The Evergreen market, Evergreen funds as an asset, as a product structure, I think is worth touching on. Roughly a $500 billion market today. This encompasses interval funds, tender offer funds, non-traded BDCs, and non-traded REITs. And there's some core benefits to this product structure. I think the primary benefit that we see is that GPs are really leaning into the Evergreen fund product as the product structure to bring private markets into private wealth. There are clear benefits, unlimited number of investors, an unlimited amount of capital that can be raised, and a permanent capital vehicle for sponsors to be able to deploy across different private market asset classes, and of course, simplified tax, issuing 1099s instead of K1s. We're in the early stages of the Evergreen fund market. Today, there's roughly $500 billion of AUM. The Evergreen market is expected to grow to closer to $3 trillion or more of AUM in just 5 years. As Tarver aptly touched on, there is a lot of infrastructure blockage for actually enabling that growth in the industry. And I think throughout the panels and conversations today, we'll hear a lot of that, those issues being discussed and potential solutions being proposed. I do want to touch on the process of buying an Evergreen fund today to make it a little bit more real for everyone in the room. Typically, an advisor will go into a platform like K's or iCapital. They'll select a fund from the marketplace. They'll fill out subscription documents for that fund. They'll kick those subscription documents over to an investor to sign. They'll then go to their custodial platform where their accounts are actually held and submit that subscription document with some sort of trade file so that the custodian can take the subscription document, send it to the transfer agent with a wire to actually settle that trade. This is why we have an 8% error rate or NIGO rate across the industry today, because there are so many people and so many different processes touching one Evergreen fund subscription document to actually make an investment in an Evergreen fund. To make the pain points more visceral, we feel this is really what's holding back the industry. These products are generally fairly illiquid. There's obviously a very high error rate, and if anyone's listened to Tarver's podcast with Mark, you'll know that Motive projects that close to 50,000 operations staff is required to reach the type of scale that we want in this industry. To put a number on that, at $200,000 a person, that's roughly $10 billion of cost just to make it easier for people to invest in Evergreen funds. So clearly, that is not going to scale. I think the trend around publicly traded closed-ended funds is an interesting sort of band-aid solution to this problem. What do you get with a publicly traded closed-end fund? You get brokerage distribution. Broker-dealers, clearing firms can actually hold publicly traded securities in their brokerage accounts today through DTCC, and you get liquidity. these products trade on New York Stock Exchange or NASDAQ, which unlocks the ability for people to sell these products if they need to. The challenge with a publicly traded product is that you have a clear difference between the NAV or the value of the fund and the price of the security on the secondary market. And so whether that's a steep discount or a significant premium, if you have SpaceX in your publicly traded closed-end fund, it is clearly not the right product to solve this problem. But it is also, in our view, a cry for help from the industry that advisors and investors are looking to get access to private markets. They're looking to get access in a more liquid way, but they're unable to do so with the existing infrastructure and the existing products. And so that brings us to the solution. Our solution is not to revamp the product structure itself, although I think there's some exciting innovations that GPs and asset managers are working on to do that. But our solution is actually to fix the core underlying infrastructure that makes these funds accessible to investors and advisors on the platforms that they use today. And so that solution is Omnibus. Omnibus clearing infrastructure is not a novel concept. This is the core underlying infrastructure that allows for so much efficiency in public markets. And to explain Omnibus in a simple form, custodians open a single account, a nominee position with the transfer agent for the fund. All of the sub-accounting, order netting, and actual trading activity that occurs in these evergreen funds happens inside that Omnibus account. And so transfer agents who today are often manually booking positions into their system of record only have to book one position per Omnibus account, allowing for trading to occur inside of the account itself. This is what we're building at Monarch with our Omnibus and Evergreen Fund solution, and we think is a core way to make the industry more efficient and unlock a lot of opportunity that so far has been gated behind a lack of efficient infrastructure. What are some of those opportunities? SMAs, including evergreen funds in model portfolios, being able to programmatically rebalance against positions in these funds as model rebalancers need to do, and removing the subscription document from the process. So instead of that sort of back and forth flow that I described where the advisor has to go into a separate platform to fill out the subdoc, to bring it to their custodian to execute the trade, imagine a world where you actually just click a button and you get to allocate into evergreen funds. And I think most importantly, changing or fixing the underlying infrastructure actually allows us to think differently about how we offer these products to clients. Mark Rowan at Apollo has spoken often about selling clients exposures instead of individual funds. And so what does that mean? That means private equity, private credit, infrastructure, a combination of a total private market portfolio solution, combining public and private into the same click-to-buy button. That's what actually makes it easier for advisors and self-directed investors to understand what these products are and be more incentivized to allocate to them. Asking advisors to pick through hundreds or thousands of available funds is another point of friction that's solved when you can actually include these products inside of a single account structure. Omnibus is not a fund of funds. This is a question we get a lot, and so I felt it was worth clarifying. Fund of funds are a separate legal entity, 40 Act fund or private fund, that is set up to invest across multiple different products or different vehicles and create effectively a separate product. Omnibus is a core underlying brokerage infrastructure. And so the key difference is getting direct access to the funds and the products that you're buying instead of going through another manager to get exposure. This may feel like an obvious solution, so I think the question is, why hasn't this been solved yet? And I think it's important to note that the real reason is that there is a lack of incentive in the industry today to solve this problem. Yes, we can talk about the big wave of capital that's coming. We can all acknowledge that more investors and advisors want access to private markets, but the actual incumbents at the center of the industry do not have an incentive today to change the way that they operate. And the reason is they are profiting off of the inefficiency. TAs often charge, transfer agents often charge a per position fee to funds. And so that means the more subscriptions that come into the funds, the more money they make. So why would they choose to consolidate around a single account? Why would they choose to make it easier for people to invest when the way that the industry works today is good for their bottom line? And so we wait for a solution to come, and we feel like we've brought that solution to life. We are not naive. We are a startup. We just raised our Series A. We know that we cannot do this alone. We need industry participation. We need incumbents in the industry that want to make a change, to buy in on this idea, to align with us, and to figure out a structure of economics that can be shared equally across the industry and actually incentivize participants to participate in a more efficient structure. And so we're on that mission to build the consortium of market players and participants that actually want to see change and that actually want to drive innovation in this space. To bring this to life in a more visceral way, we all have lived through Q4 and Q1 in the private credit space. Evergreen funds in particular have seen a huge amount of redemption requests. Many of those redemptions have been gated. Boaz Weinstein put out a 35% discounted bid to buy into one of the Blue Owl funds. I think it's notable that actually only 1% of that bid got filled instead of the full 7%, showing that people do want liquidity, but they don't want liquidity at a discount. They want liquidity at the value that the fund is striking. And so with Omnibus, instead of all of those sell orders hitting the fund at once across Q4 and Q1, you could have actually netted out that flow. I think there was roughly $6 or $7 billion of inflows that came into the private credit space across Q4 and Q1, which roughly matched the amount of selling pressure that these funds were experiencing. And so imagine if you could actually net that out. What would that mean for the private credit space? No negative headlines, no bank run, people actually being more excited to allocate into the market across both institutions and retail. And that is possible with Omnibus today. I'll leave you with 3 things, 3 core principles that we share at Monarch in our vision for the future of this space. The first is that the future of private markets is evergreen. The second is that the future of Evergreen is Omnibus. And the third is that the future of Omnibus is Monarch EFO. Thank you very much.